Hey, everybody, this is William Honolulu Jr., and welcome to the Part Time Entrepreneurs series. This portion of the series is called Financial Basics. Talking a little bit about what the Part Time Entrepreneurs series is, it's an opportunity for those entrepreneurs who aren't doing it full time, for those who, I guess the term is, this is their side hustle. It's an opportunity for them to get to know business more intimately, to get to understand how some of the different areas of business work, and to make sure they have the tools necessary to be successful in the short and long term. As you all know, I'm the president of the Honolulu Group LLC. What you may not know is my academic background and a little of my professional background that can give you a sense of comfort about the information I'm going to present to you. I have a Bachelor's of Arts in Political Science from UMBC, or the University of Maryland, Baltimore County. A really great school. I have to give a shout out to it. I have a Juris Doctorate degree, which is a degree in law. I also have a Master's of Business Administration degree. Both of those degrees, or both of my graduate degrees, I got from the University of Baltimore. I spent some time as a financial specialist, which was a job where I had an opportunity to work with not just individuals, but small business owners and helping them understand how the banking industry or how their banking situation could assist them in leveraging opportunities to make their business successful. That included things like explaining balance sheets and credit statements and things like that to them, also helping them understand their cash flow and some of the things that we'll be talking about today. I also spent some time as a small business consultant, small to moderate sized business consultant for the Small Business Development Center Network based in Maryland. I was a budget analyst for the Department of Legislative Services, and that organization is one that supports the Maryland General Assembly. So, this group of people, professional staff, they analyze the budgets of the various state departments. For example, the budget I was responsible for was the Department of Public Safety and Correctional Services. And that budget was about $1 billion. So it gave me an opportunity not just to see how the budgets are created, but some of the decision making processes that went in the background to really make those determinations. And the General Assembly, like most state legislatures, serve kind of as a board of directors, as it were, for state finances. Total state budget was about 24, about 23, $24 billion at the time. So this just gives you kind of a sense of some of the scope of opportunity. Also, I'm the president of RadioForReal.com, which is an online radio station designed to help small, not just small entrepreneurs, but independent artists and independent musicians really get their music out and have a voice. We also provide radio services and distribution services of their music and give community organizations and individuals engaged in the community an opportunity to tell their story and really get the word out. It's also really important to me that you have an understanding of what we're planning to do during the course of this presentation. Our objectives, our learning objectives for those trainers in the room or in cyberspace. The first thing is to understand the importance of financial management to your business. A lot of times people think that since they're doing entrepreneurship part time, that managing finances in a really determined or concerted way isn't really all that necessary. Um, that is one of the quickest ways to financial ruin and to turn your business into a hobby that costs you money instead of making you money. We also want to be able to develop basic financial statements. It's really important that people use their financial statements as management tools. Sometimes we think of financial statements just as those things that bankers or lawyers or some other group of people use, but they're really important for management of an organization or management of a company or management of a part-time enterprise to really get an assessment of how successful the business is going and what needs to be changed. And we'll talk about that in a little bit more detail. To become familiar with kind of basic financial vocabulary. When you're interacting with your accountant or your banker or whomever, it's important that you understand the words that they're using. I've had many clients who come to me on for business consulting, and we'll be having a conversation, and I'll explain a term, and they'll go, "Oh, that's what my bookkeeper or that's what my accountant was saying." And when I ask them, "Why didn't you ask them then?" and the honest answer is normally, "I didn't want to embarrass myself." understanding the desire not to embarrass yourself, but it's really important that you understand what your business is doing and that you understand the language that people are using to describe your business success or some of the challenges you may be facing. We also want to be able to determine how to maximize the return on your investment in assets. This becomes a really critical piece when doing business, especially part time. Doing business part time, you don't have an opportunity to, make it up as kind of make it up as you go along. For those who are doing entrepreneurship full time or running their businesses full time, they kind of learn on the fly, and if they make a misstep, a lot of times they have the time to go back and take care of those missteps. But it's really important to start thinking about your business from a point of return on investment or return on assets, because otherwise, again, you have a hobby that you'll end up paying for. And also how to understand how to protect your money. At the end of the day, business is really about the money that you make. People talk a lot about feeling good about what you're doing and those things. You can feel good about what you're doing by volunteering in the community. Most people engage in business to make a little extra money or to get some level of financial freedom, or not even freedom sometimes, just comfort, to keep your head above water in some cases. And if you don't understand how your money works, you may never be able to achieve that. So who knows where you end up? It's important before we get started also to make sure that we set a few ground rules. Now, these ground rules are Williams' general rules about business. These are no one else's. I take full ownership and responsibility for them. And speaking of responsibility, that leads me to the first rule. Your business is your responsibility. There have been times where my clients come to me and tell me, well, my accountant said this, or my staff did that, or I did this because someone else advised me, or my cousin said, or one of my suppliers said, and I did this, or the salesperson said, blah, 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 blah. It's your responsibility. If you are not managing your business, if you're not taking control and finding people that you can work with and trust and who are competent, then the outcome is really your responsibility. If you engage in a decision, or if you make a decision based on information that you receive from a source that isn't credible, it's your responsibility. If you didn't plan for a contingency, again, that's your responsibility. And I think it's important to pay attention to the lines of responsibility, so that not to scare anybody, but just to make sure that we have a responsibility as entrepreneurs to be vigilant, especially the part-time entrepreneurs. The next is that planning is the key to success. There is a saying that if you fail to plan, you are planning to fail. That is incredibly true. Now, we shouldn't get what people call the paralysis of analysis. That's another thing you'll find. If there's a saying about it, I've probably heard it, and I will probably use it. Um, you shouldn't get paralyzed by trying to figure out and plan for everything, because there are some things that will come that you cannot plan for. But the issue is making sure that you plan for as much of it as you can to maximize your likelihood of success. All the advice that you get is not valuable is the third ground rule. And I say that not necessarily talking about the advice that you get here today as you're going through this, because I'm hoping that all of it is valuable to you, but making sure that you pay attention to the credibility of your sources of information. You have some people who provide advice from their perspective, not recognizing some of the nuances of your business, some of the nuances of your customers, your clients, your market, or anything like that. So following their advice may not be helpful to you. Always take advice with a grain of salt and take it and make a decision on your own. Don't just follow it wholesale. Always do your research. Make sure that you understand the market that you're getting involved in. Make sure that you understand the different things that could happen. Understand your business, your product. The next is to make sure that when you take risk, that the risks make sense. One of the things people talk about with entrepreneurs is that entrepreneurs are risk takers, risk takers. They take risks. They do the things that everybody else is afraid to do, which is true, because it takes a lot of courage to step out and to start a business on your own. But make sure that that risk makes sense. If the likelihood of success is slim, then take that into consideration. If you can spend $1,000 to get 1,005, that might not be a risk that makes sense. Or if you take a risk and there's a long shot that you'll be successful, again, risk may not make sense. So make sure that when you take a risk, that it makes sense. The next is incredibly important, particularly for new entrepreneurs and for the part-time entrepreneurs, is that it's always business. It is never personal. At the point in my experience, at the point that it becomes personal, that's when the entrepreneur loses because it's business. There are people that you may not like personally that you need to do business with. There are people who may have characteristics that you don't appreciate or that you find offensive. These are people that you may have to do business with. And there may be people that you love, family members, friends, people who go to your same religious institution or what have you. You went to college together, your roommate, or I don't know, but it's business. Because when it becomes personal, one way or the other, whether it's people you don't like or it's people that you love, you run the risk of making bad business decisions based on personal feelings. Um, there are some people in my life that I love tremendously. I would never do business with them. There are other people in my life that I find deplorable that I will write a check to because I know there will be an incredible return on my investment. And then there's some that we run the gamut, or we can do a little bit of both. There are people that are really good friends of mine that I tell them when we get ready to do business that we're doing business as business people, that if the business goes well, that's great. If it doesn't, that's great. We can still go out and hang out, and you can come to the cookout or what have you later. The next is to mitigate your risk. Again, as a risk taker, not just making sure that it makes sense, but you do those things to ensure that the downside of risks are mitigated. And what mean by mitigated is to ensure that the risk is not just open. So if you're investing $1,000 in a job or in a project or in an activity, you want to make sure that you can get as much of that $1,000 back if the business is not successful or if that job isn't successful. The next is that remembering that your job is to make money in business. I think that's pretty self-explanatory. And the last ground rule is don't get too focused on one aspect of the business. If the example I love are phenomenal cooks who become caterers, they get so caught up sometimes in the taste, the artistry of their craft that they forget to manage sales. They forget to manage expenses. They forget to manage personnel, their taxes, and things of that nature, their legal liabilities, their contracts, and those things. They get so focused in one aspect that they forget the other. Or vice versa, you have some people who are phenomenally good at business, but the business that they got into, they forget about it. They're so busy worried about sales and forecasting and those types of things that customer service suffers. Don't get so focused on one aspect of the business that you lose sight of the rest of it. Again, particularly for the part-time entrepreneurs, because many of the part-time entrepreneurs don't have staff that help them manage the different aspects of business. Hopefully, the ground rules make sense to you. Now we're going to spend some time talking about why financial management is important. The first thing is that it guides business activities. What I mean by that is that if you understand how your finances work and what money goes where and how your money is moving, you can have a better opportunity to assess the viability or the importance of certain business activities. You may find that some of the business activities that you engage in most generate less revenue than some of the other ones that you engage in least. For example, one of the things that people don't really understand a lot of times is that one of the reasons that gas stations started putting convenience stores with the instead of just the place you go and get gasoline is because the margins on some of the products that they sell in the gas stations in the convenience store part is a lot higher than on the gas itself. But until somebody looked at the numbers and figured out how much money was coming in for what activities, they couldn't determine which one would be a good idea. Now, it demonstrates strategy and planning. This becomes really important at the point that you're looking for getting for investors or looking for credit for your business. If the person that's extending you credit or the person that's investing in your business understands that you understand how your money works, then they'll be more likely to invest in your business. Remember, they may love you, they may trust you, but at the end of the day, they're in this for return on their investment. And you have to show them that you understand the importance of that. Now, it also establishes benchmarks to evaluate your business activities. It doesn't just tell you what business activities are bringing in more money or what business activities are doing this and doing that. It also gives you a benchmark. What that means is you can look year over year and find out, what money is coming in and are we doing well? Especially if you've been able to do some competitive analysis and determine what your competitors are doing. So if your competitors' profit margins, let's say, are 25% and your profit margins are 10, it does not sound like you can sustain a price war. If your profit margins last month were 10% and this month they're 20%, that suggests that either costs have gone down or something good has happened because you're making more money to keep. So it helps establish those benchmarks. Now, business success by and large, both the business success you can enjoy today and the business success you believe will happen in the future are based on the way you manage your money. You may have a wonderful contract, a $200 million contract, but if it takes $10 million to get it started, and you don't have the $10 million, that contract really isn't worth the paper it's printed on. It's kind of like when you work for someone else and they tell you you'll start 2 weeks in the hole. One of the things you have to do is determine if you can afford not to be paid for 2 weeks in order to in order to take the job, even if the job pays a lot more money. A lot of the times the businesses come to me when they're on the brink of failure and we're trying to rehabilitate them, or in some cases, I guess, habilitate them in the first place, is that they have not managed their cash flow. They may have good activities, generating lots of invoices, generating lots of revenue, but that revenue isn't hitting the books, isn't coming through the door. Money that people owe you isn't that helpful because you aren't able to spend it. So it's really important that when you manage your finances appropriately, you can have greater control over those types of things. And in my experience, and you can ask accountants, lawyers, business owners, bankruptcy lawyers, and bankruptcy judges, what we find more often than not is that businesses that don't manage their money well, they really don't end up surviving long. So it's really, really important that you manage your money. Now, there's some very fundamental questions that you need to ask yourself before you begin business or before really sitting down to evaluate your financial situation. One of the biggest ones, and which may sound the easiest, but in my experience hasn't been for a lot of companies, is the question of what type of company do you have? When you ask yourself what type of company you have, it gives you an opportunity to really evaluate your competition and also to see what margins or what financial benchmarks make sense for your company. If you are a marketing company, that's different than being let's say, an event planning company. The benchmarks to know whether you're successful, the people that you're competing against, totally different. There are two other questions that are really related, but sometimes people don't think of them as such. How much startup money do you have? And then the question, how much startup money do you need? Sometimes my experience has been that sometimes my clients believe that they take the money that they need and then back it down to how much they have. It really should go the other way. You spend some time looking at how much money do you need to really do your venture, to really make your business work. Then you look at how much money you have. The difference between how much money you have and how much money you need is either a positive or negative number. If it's a positive number, it means that you're working with some cushion and you can move forward on your business knowing that you have some money in reserve. If the number is a negative number, that suggests that you need to stop, take some time, and get some more money. Put some money together and make sure that your business is well financed. Otherwise, you'll end up in a situation where you'll lose. Not only will your business have a lower likelihood of being successful, but you'll also lose the money that you put in to begin with. The next question is how much money will come into the business? And again, linked is the question how much money will leave the business. This is more a question around cash flow. Now, some people don't understand what cash flow is. And let's just talk about that for just a second. Cash flow, we'll get into it a little bit later, but we're going to spend some time on it right now. Cash flow is the movement of actual dollars and cents in and out of your business. You can have a really great contract. Let's say you have a contract that's worth $1,000,000 and it costs you $500,000 to get the contract done. But if they don't pay you until the end of the contract, that means that you have to come up with $500,000 cash or $500,000 in financing before you can actually get to getting your million. So that's why cash flow is important, because money made on paper is just that, paper. And until you cash it out or until you complete what's necessary to get that cash in the door, sometimes it doesn't really matter. Now, when does money come in and flow out of your business is also another question related to cash flow. These questions really help you focus on, is your business sustainable based on the resources that you have. Now, additionally, you need to pay attention to what assumptions have you made about your business and about your finances. If you assume that you're getting paid every month or every day from your clients, that will change the way that you operate, because that means that if you're getting paid every day, uh, you have one set of expectations, you have one set of ideas about the operations of your business. But if you're getting paid every month, then that's something different. So you need to understand what assumptions that you've made, so you can make sure that your business flows properly. And did you document all of the information underlying your financial projections? When people bring financial projections to me and they say, well, this is what I think is going to happen, or this is, this is a good profit margin, or this is how much money I'm going to make, or these are even how much my expenses are going to be. My question always to them is, well, where did you get that information? Are you guessing? Is it based on your years of experience, or did you get it from some other source, looking at your competition or what have you? These are really important questions before you move forward on your business. Now we're going to switch gears a little bit and talk about some of the forms and documents that help you with your financial management. The first is the balance sheet. The balance sheet is the basic financial management tool. What it is just an equation. Is you take all of your assets, you subtract your liability, and what's left is what's called owner equity. So, what are your assets? You have several assets, and some of them are cash. That's a really easy one. Accounts receivable, inventory, and some of your capital assets. And by capital assets, we're talking about things like significant equipment, things like buildings and property and things of that nature, because those have a retained value. And depending on how you structure your assets, or how you, what they call, depreciate your assets, depends on how much is on your balance sheet or what have you, or some of the other forms, the income statement and the like, as you go along. Your liabilities are things like wages, debts that you owe, any leases that you still have payments on, accounts payable, and taxes. Any money that you owe. The difference between accounts payable and accounts receivable is who owes the money. If the money is owed to you and it just hasn't been collected yet, those are accounts receivable. If it's money that you owe to someone else, those are accounts payable. So if you extend credit to a customer, receivable. If a vendor extends credit to you, that's a payable. Okay? The thing about the balance sheet is that it's a snapshot in a place in time. What most companies do is that they use their balance sheet time frame at the same place every year. So let's say December 31st of each year, that's when you take a look at your balance sheet, and you can compare the balance sheet from last year versus this year, or do it every 6 months or some regular interval. Particularly if your business is seasonal, your balance sheet won't look the same each time that you pull it up, if you pull it up or if you pull it together most time throughout the year. So balance sheets are really important to give you kind of a snapshot and figure out what exactly you have at a particular time, and to give you a basis for comparison from one time frame to the next. The next document, or the next tool that we'll look at, is the income statements. Again, the income statement is based on a very simple formula. You take your revenue, subtract your expenses, and that leaves you with your gross profit. Now, revenues are pretty easy to identify. Those are the things that that's the money that comes into the business from sales or any other source. If money is coming into the business, it's considered a revenue. Okay, really simple, right? Now, if you look at expenses, those are all the things that have a cost to you, whether that's utilities, there are some sales costs, and well, let's take a step back in revenue and look at the sales. When you look at the revenue from sales, you have to subtract the cost of goods sold. You'll see that sometimes COGS, cost of goods sold. What that is that how much did it cost to get that sale? Because that is what your true revenue is. Some people do it differently. Some people subtract the cost of goods sold directly from the revenue, from the sales, the actual sale when it comes into the organization. Others actually factor into the expenses. Personally, I look at it. I think it makes more sense when you take it into the consideration when you're doing your expenses, because I think that's more reflective and gives you better information on which to base your decision making. When you're looking at going back to expenses, when you're looking at things like general administrative costs, postage, when you're looking at things like utilities, paper, those types of things, the general administrative. Depending on what your business is, you may have some research and development costs as well, and depreciation. Depreciation is when you take a large asset like we talked about before, and you depreciate its cost, or you take the cost and divide it over its useful life. So, for example, the useful life on a building may be 30 years, 50 years. So, you take the cost of the building and divide it over 30 years, and that each year you assess that against your income statement. You also have things like interest. So, if you have a loan, and you're paying back the loan, you look at the loan in two parts. You look at your payments on the principal, and then you look at your payments on the interest. List them separately. And then any taxes that you may owe, whether that's sales tax or whether that's income taxes or anything else. Now we're going to talk a little bit about the cash flow statement. We discussed cash flow a little bit ago, but the cash flow statement is the document that kind of represents what that means. Now, cash comes into your business from a lot of different sources, and let's make sure we're focused on the cash that comes in, not the completion of the actual sale, because sometimes you can complete the sale and then bill or invoice the customer, and it may take, 20, 30 days. Unfortunately, I've seen some of my clients that it takes 2 years to collect the cash that they're owed. So we're not counting money that's owed to you. We're only talking about money that comes in the door or gets deposited into the account. Okay. Now, you have to get money from somewhere, but there are different places that it comes from. You can get money from your operating activities, which is normally where businesses like to get their money. It means that you engaged in an activity with a client and that client exchanged money to you. Now, one of the ways that businesses get the cash in the door is that they offer incentives to clients to pay at a particular time frame. So sometimes you'll get a discount for paying in 30 days, paying within 30 days or before 30 days. So let's say if a client has 30 days to pay, if you have terms of what they call net 30, that means the client has 30 days to pay from the date that this invoice is sent. Then you may say you get 10% off, or you get 5% off, or you get 20% off if you pay within net 15. The reason that you do that is that the faster the money comes into you, the more likely it is you'll be able to use it effectively for growing your business. Also, it means that it's more likely that the client will actually end up paying, because that is something that you have to take into consideration. Now you can get cash into the business from investing activities. That means that there is someone who's investing for ownership interest in your company, and they're giving you money for that investment. Now that's still cash coming in the door, but it's cash coming in from another source. You can get money from financing activities. Cash will come in. You can take out a loan, and the lender, the bank, or the individual lender will give you that cash, and that's cash that comes into your business. The reason that we make a really big distinction and we kind of harp on the difference between cash and money owed is because cash you can actually use. You can't really spend money that you don't have. Unfortunately, I've seen clients who do it, but you really shouldn't spend money that you don't have yet. Uh, when you actually have cash, you can grow your business in a lot more focused direction. And also, when you're looking for investors, they want to see that your return on investment or their potential return on investment is more than just paper money. No pun intended. The other part about the cash flow statement is that makes it really critical is looking at the timing that this money comes into your business. Because that becomes an issue around effective financial management. If you have terms of net 30, but your cost or your terms for your suppliers are net 15, meaning that you have to pay your suppliers 15 days after invoice, whereas your clients pay you 30 days after invoice, there's about a 2 week period there where you don't actually have the cash in, or you don't have the cash in to pay your suppliers. Or vice versa. Let's say your clients pay you in net 30 and your suppliers pay your suppliers in net 45. That means you have a 15-day window where you actually have cash on hand, and if your supplier can negotiate, if you can negotiate a discount with your supplier, you may be able to take advantage of that. But if you're not monitoring your cash flow, you'll never be able to know exactly what you can do, how much money you have, and when you need to either be concerned or celebrate. Now let's take a look at some of the things when you're putting together your budgets or when you're putting together your expenses, what have you, some of the things that you need to take into consideration when operating your business. First is reasonable salaries. And you notice I'll put the word reasonable there. Um, the reason is that when people are starting businesses, particularly people who this may be their first venture or their first time paying themselves, they'll do one or two things, has been my experience. One, they'll put really high salaries next to their names or the people that they want to bring in to assist them, or they'll do really low salaries. Do some research, find out what other people in the industry or in your market make to do something very similar. That would be a really great benchmark for you to determine what's reasonable. One of the things that we look at when making decisions or when I do financing or help people with financing is that banks and lenders and also investors want to see that you actually know what you're doing. So they're taking a look at the numbers that you submit and determining whether they're reasonable or not. The next is cost of goods sold. If it takes you $30 to make and to sell something that costs 50, and I can do the same thing for $20, then not only can we get into a really big price competition, my gross margin is higher than yours. Now, it also goes back to what investors and lenders may be looking for when they're evaluating your business plan or your ability to manage the finances of your business. If you say that based on your estimates, it may only take you $10 to make it, and the lender knows that the market or the industry standard is about $30 to make it, the same product, the lender's going to consider that you really may not know what you're doing. So again, you need to be able to justify where you came up with these numbers. If you're coming up with the numbers out of whole cloth, then that's not really a good sign of the likelihood of your business's success. Looking at advertising and promotion, you need to make sure that your advertising dollars are well spent. If you are, let's say, developing you're developing products to service blind people, having really high graphic, high resolution color copies of flyers that you're distributing probably not the most effective use of your resources, unless of course you can justify although the product may be for blind people, that the people purchasing the product are the sighted. So that's kind of an extreme example, but you need to focus on what your clients look at, what they listen to, where they get their information when making purchasing decisions, and go there. But you need to make sure that these expenses are captured and that they're too reasonable. When you look at real estate and equipment, make sure that you distinguish whether you're purchasing the equipment or the real estate or whether you're leasing it. The reason why that distinction is important is that if you're purchasing it, the cost that you pay down normally roll over into equity so long as the underlying market is stable. So if you're buying, let's say, an office building that you'll be working out of, then the money that you spend purchasing that building will later translate into equity in that building, as opposed to renting space. And at the end of the day, or at the end of your lease term, you don't have actually any equity to show for it. Now, that's not to say that purchases are always preferable to leases. There are many instances where leases actually make a lot more sense, particularly for the part-time entrepreneur, than purchases do. Sometimes I've noticed that when people bring their financial plans to me for their businesses, they don't take into consideration utilities. Even if you have a home office, you should take into consideration the utilities that you use to operate your business out of your home. Supplies, how much does copying paper take? How much does ink take? How much are these things? Um, how much of them do you use in a given time? If most of your activity is done via the internet, emails back and forth, digital signatures, you may not spend as much as someone who, let's say, a lawyer developing documents for discovery or making copies and things like that. Absolutely different. So you need to make sure you take those things into consideration. You'd be surprised how many businesses don't take into consideration insurance. Or if they do, they look at the minimum amount of insurance that they need, particularly part time entrepreneurs. It is critically important that you get all of the insurances that you need. Sit down with an insurance broker, explain what your business does, explain how your business operates, and then figure out what insurance do you need. Granted, remember that the insurance broker is a salesperson and their job is to sell you things. But also to listen to what they say and make sure that it makes sense to you, because there's nothing worse than working really hard, making a lot of sales, and doing real well with your business, and then having that money taken from you because of unexpected liability that you could have gotten insurance to cover. Some entrepreneurs, particularly part time entrepreneurs, think that insurance is a waste of money. I hope for your sake that every dime you ever pay in insurance is a waste of money. If you look at your car insurance, if you ever have to use your car insurance, that means something bad happened. That means you got into an accident, or your car was stolen or something like that. I hope for your sake that every dime you ever spend in insurance you feel is a waste, because that means you didn't have to call it in. That means that something bad, that unfortunate incident that insurance is designed to protect from, didn't occur. There are license fees for many of the things that some part time entrepreneurs do. Make sure you take those fees into consideration, or the fees for licenses, or the fees for continuing education to maintain your license. For example, in Maryland, insurance agents have to take a certain number of what they call continuing education units or continuing education credits, or you lose your license, so you're not able to sell insurance anymore. So take those things into consideration when developing your budget. Also, annual government fees. A great example is in Maryland, it costs, I think, about $300 for a limited liability company or a corporation just to file the personal property tax document. Doesn't Even if you're filing and say you have no personal property on which they can tax you, to file that sheet of paper or to file that document still costs you $300. And depending on what licenses you have or what industries you're in, you may still have to pay three, four, $500 a year just to operate. Oh, sorry, just to have the ability to operate your business in a particular state or local jurisdiction, because sometimes you may have to pay uh, a certain fee to the state, a certain fee to the federal government, and then again another separate fee to the local government. So make sure that you're paying attention to that. Your loan repayments, any financing that you've done for your business, you need to take those into consideration, and your taxes. Make sure that you know whether sales tax is applicable to you if you're selling on the internet, or if you're selling in real life, if they tax services or if they tax the goods that you sell. You need to take those into consideration, because the government tends not to be all that forgiving when you don't pay them their tax money. Some people are asking, well, where do I get this information from? How do I benchmark my business? How do I know if I'm doing what's right from a financial perspective? Well, there are a lot of sources of information. One of the best sources is the actual history of the business. If you've been operating this business, even from a part time basis, for a period of time and you've been keeping good records, you can take a look at those records and do an analysis or just take a to see if there are any trends that you can identify. Do you notice that in some months revenue goes up while in other months revenue goes down? That is really great information because it tells you how to plan. If you know in June your revenue shoots up and in November it goes down, then you know the money from June may need to last you, or when you get to September, October, you need to start moving money into reserve so you can make it through November and December. But that is really great information, especially because you are just extending the information. You're just extending what you already know using your business's history. As good a reference point or as good a resource can be the owner's experience. Let's say you are opening up a business in retail and you have years working for another company doing retail. That gives you a lot of really good experience. You know your customer base, you know what you're doing, you have seen the operations of a business, particularly if it's a successful business. And you can use that to build on to make sure that your business is a success. Taking a look at how the finances of that business were managed and also what the benchmarks were there. You can do what they call competitor intelligence. That's a fancy way of saying, what is my competition doing? What are their benchmarks? How do they know when they're successful? Getting that can be a little dicey at times, but there's some organizations, some businesses that more than happy to tell you what's going on with them. You can look at public records. Public records are really good to determine like the liability of certain organizations. If you see that organizations in your industry or in your area are being sued on a regular basis in public records, that's a pretty good indication that you might want to get better insurance or make sure that you can mitigate those losses. You can look at industry analysts. You have analysts all over the country in virtually every industry who write and publish information in newspapers and journals and different other publications. You can use that to try to figure out what's going on with your competitors or really good benchmarks. There are government filings. One of the best ones, in my opinion, is the one the SEC, the Security and Exchange Commission. They call it the Form 10K. If you look at the 10K, it tells you what businesses have done. I mean, there's some lag time behind it, but it really does give you a good snapshot of what's happening in other organizations. Make sure you read newspapers and magazines and trade publications in your industry. There are numerous reference books that just outright tell you what your ratio should be based on historical averages and what they know, what these authors know about the industry. And then, as always, the internet is a phenomenal resource. But make sure that when you're using the internet or any of these other resources, that you are clearly paying attention to the source of the information. That a web page because I want www because I think this is true.com or something like that may not be the best reference point. Try to stick to reputable organizations, maybe a JD Power, Consumer Reports, Barron's, Moody's, even Motley Fool. So try to stay with something that has a track record of success. Now, we've gotten to this point, and you may ask yourself, I've gotten my balance sheet together, I've gotten my statement of cash flows together, I've gotten my income statement together, I've gotten all of my stuff together, I've done my research, I have my business history. So, what do I do with all this information, all this financial information that I have? How do you use it? How does it even add value to your business? Well, let me tell you. It helps you plan expenses to meet your cash inflows and your cash outflows. So we talked about it kind of as we were going along. When you know what your cash flow is going to be, you can plan for it. It measures business performance and helps you make business decisions. Using the gas station example from earlier, when you have a situation where you can identify a different line of business may help you not just augment your original business, for the gas station owners, throwing in the convenience stores doesn't just help them get more customers to buy gas, but it actually makes them more money than they would just selling gas. It also positions your business for investment and financing. At the end of the day, most investors and most lenders want to make sure that they're going to get a return on the loan or return on the investment. They want to make sure that the business is financially sound and financially healthy so that they can ensure that they're going to get paid. It also provides information for tax planning. If you know what money is going to do in your business from the time that the year starts, you can plan to spend money in good ways so to reduce in ways that reduce your tax liability. Otherwise, you're just going to be guessing at the end of the year about how much you may owe the government. It also, the financial information gives a basis for strategic planning so that you know not just what you want to do or what you can do, but how you can position your business in the short and long term for greater success and a larger market share. It also provides guidance for operating and marketing decisions. If you find that some of your clients aren't spending as much as other clients, or some of your business lines aren't providing as much as other business lines, it gives you an idea of whether you need to dedicate more or less resources to those business lines. Now, the question always comes up, how do you protect your finances? The first thing you have to do is understand your assets. If you don't understand how your assets work and whether those assets are your human capital, whether those assets are your equipment, whether the assets is your reputation and goodwill, or whatever those assets are, if you don't understand what they are and how they work, then it's likely that you can lose them, and or you may not be getting the maximum efficiency or the maximum revenue from them. The next thing that you need to make sure that you're doing is that you have effective contracts and leases, making sure that those agreements are to your benefit and don't just sign something because they give it to you and tell you it's the standard agreement. Standard agreement means that it's the regular one that whoever is giving it to you uses. Sometimes people don't realize that standard agreement doesn't mean that it can't be altered. It just means that this is just what we always do. Just because they've always done it doesn't mean that it's the right thing to do. Now, making sure that your bank accounts are titled properly. For example, if you have a bank account that is holding your client's money, you need to have it titled so that if you, let's say you have some liability, that money can't be attached, that they can't go after that money. For I had a client whose business was doing fairly well. They were working with some grant money to do some community outreach and to assist their clientele. What happened is that they got sued and they lost the lawsuit. And that client ended up having to pay or actually had the account garnished. And the garnishment took away not only their operating money, but all the grant money as well. So now not only are they out of the grant money to do the work they were supposed to do, they had some contractual issues because that grant money was supposed to be used exclusively for the benefit of the community or their clientele. So now they're stuck. It's important that if they had their accounts titled properly, and your banker or your tax professional can assist you, but if they had the accounts titled properly, when that garnishment came, it wouldn't have been able to get in. They wouldn't have been able to use get the money from that account. Now, monitoring your finances is also important in protecting them, making sure that your books match the bank's books matches your bookkeeper's books. It's always good to have a check and balance and to reconcile all of that information, reconcile your credit card receipts, your credit card statements with your accounting books, with your bank statements, to make sure that there isn't money missing or anything funny isn't going on. You also need to focus on your accounts receivable and your collection activities. Many businesses have a lot of great revenue on their books. It looks good, but what's happening is that it's not cash flow. It looks good on paper, but it just becomes paper. You may have a business that's carrying like 20, 30,000, sometimes even 50, 60,000 on their books for 90, 120, 180 days. That's not really healthy for your business because what you're doing is you're subsidizing your client's lifestyle. Estate planning is also really important because let's say you have a partner, or yeah, let's go with the partner example. Let's say your partner is a really great person and is committed to the business, but your partner's spouse or your partner's sons or daughters, they aren't really fond of the business. If your partner passes away, then the spouse, the son, the daughter, the sibling, the heir may become your new partner if you haven't planned for that appropriately. When you look at insurance, we talked about this before, but insurance helps ensure that if something bad does happen, if there is a liability, if there is an event that causes a level of loss, that you're covered. It becomes critically important that you're covered because otherwise, you'll have to find a way to take your operating money, continue to operate your business, and take that operating money and pay off the liability. Make sure that your expectations are realistic. If you don't have realistic expectations of your finances, you will be disappointed. That's just the bottom line. Make sure that all of your activities or all of your expectations are based and well grounded in reality. When you get advice from people, like we talked about before, all advice isn't reasonable. All advice isn't valuable. Make sure you're getting advice from people who actually know what they're talking about. The last thing on protecting your finances is make sure that you have control of your finances. That everybody doesn't need access to petty cash, or everybody doesn't need access to the bank account. Making sure that you have appropriate access, appropriate control, that will become indispensable in managing your resources and making sure your business stays financially healthy. Now, here are some sources of additional information that you can use to really help with this whole process and preparing your financial statements and getting a grip on your financial resources and financial planning and management. Talk to your accountant and your tax professional. They can be invaluable in helping manage money. That's what they do. There's a website called answers.com. You have entrepreneur.com, which is an incredible resource. Investorwords.com, because sometimes the vocabulary of business can be a little intimidating. And the people who do business and do business finances and management, it's like they speak a whole other language sometimes. And it's really important that you know that language so that you can make sure that that you're, that you understand what's going on. There's a website called Fool.com. Now, don't be fooled by Fool.com. The name may sound a little funny, but they do really great work in explaining some of the complicated accounting and financial concepts really clearly. There's also the Government Services Administration. They have a website called PuebloGSA.gov. There's a lot of really good resources for small businesses there as well. A book that I recommend is Financial Management, and there's the 13-digit ISBN number, and also Finance for Non-Financial Managers. Again, really great resources, and there are hundreds and thousands of others out there, but these are just a few of the ones that I recommend that you use. Well, thank you all very much for sticking with me through this, and I hope that I added some value. If you have any other additional questions, concerns, or anything that you would just want to talk about, you can shoot me an email at hanablue@aol.com or give me a call at 443-790-4848. Thank you all, and have a really prosperous future.